We're half an hour away from the opens in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to your top stories as we wrap up this trading week. Chinese assets in focus after Beijing signals increased public borrowing and spending to boost consumption, as well as raising the fiscal deficits. Officials also pledging to keep the currency stable.
Asian stocks in the red as investors rein in risk appetite ahead of the Fed's meeting next week. The ECB cutting rates for a third straight time.
And Broadcom surges in late trade after predicting a boom in demand for its AI chips.
All right, taking a quick look at the market action this morning. You've got Asian equities a little bit under pressure so far. US futures steady right now. Overnight, we did see them pulling back a little bit on Wall Street stocks, and that was really as traders sort of assess what's the outlook for the Fed next week. We've pretty much got that 25 basis point cut priced in at this point. So you're seeing a little bit of red across the screen here today. Watching Korea in particular, we've got the Gallup poll coming out in just a few moments, indicating where President Yoon's popularity or standing is right now. We have seen that slipping over the past few surveys, and also him facing a second impeachment vote. What else we're tracking in the session today comes down to yields. We're seeing those fairly steady right now, and also seeing a little bit of change really coming through in the greenback. But let's change on, because it's that focus as well on what's happening in the AI space. And here we actually did see some moves to the upside overnight. Broadcom, you can see after hours, up 15%. We had its earnings coming out, signaling strong support for AI-related chips. Its chips going into AI servers, and we are seeing some of its supplies, again, moving a little bit higher in the session so far. We also do actually have a listing, a trading debut in Sydney today, DigiCo REIT. That is another data center play in this space as well, so we'll track how those shares come online. Also taking a look at what's happening in China today. Of course, we saw the Golden Dragon Index overnight. Those moves with investors really reacting to this latest lines that are coming out in terms of the Central Economic Work Conference. We know the fiscal deficit could be lifted. That target, Xinhua local media saying up to 4.5%. Little change so far, reeling the Golden Dragon Index overnight. Taking a look at what futures say as well ahead of the session today, it does seem like there's still that call. Firstly, where is the fiscal deficit going to land? And secondly, what are the actual steps that we're going to see to try and boost consumption, Dave?
Yeah, some of the numbers out there, and I'm just looking at my terminal, that are being floated north of 4%. I mean, certainly you understand why this bond rally keeps going right now. In fact, the reason I bring that up, I'm just looking at the 30-year yield, the 10-year yield just now ticking out the 1.8% level. In fact, that's really one of the items on the agenda today. And lo and behold, we're here right now. We're just about 1 basis point above the 2% handle on the 30-year yield. We have a 2-year bond auction today. We did get a massive rally in consumption plays yesterday. So a lot of the F&Bs, Haidilao, Lao, you had Budweiser Brewing, just to name a few, that did see substantial gains going into yesterday. Let's see if we close above the 4,000 handle on the CSI 300 this week. And we are still in that window for credit data, which tends, not always, but tends to come out on a Friday afternoon, which I imagine for any potential, that's the operative word, potential easing measures also comes into the weekend. Citi is out with a note. They expect a triple R cut to come, actually, as soon as today. So maybe watch for any potential moves out there. But it's not like easing is something new here, Bill, when you look at what's been taking place.
No, we've certainly seen a lot of calls to that, and also really, as you say, to your point, being reflected in asset prices as well, what we're seeing in the bond space. But how this Central Economic Work Conference is also being communicated, the wrap-up in local media is also another talking point. We've got an economist writing for Xinhua Finance that the government, as I said, could raise the fiscal deficit next year to a range of 4 to 4.5%. That's Lian Ping of the Guangkai Chief Industry Research Institute. And he's saying that an increase doesn't carry too much of a risk when you consider how China's finances and debt levels are standing. He also says the fiscal deficit has remained at a relatively low level for really too long. Experts are also weighing in on how China can stimulate domestic consumption. That really is the key talking point. One analyst tells the Securities Journal that monetary policy will play a key role by supporting consumer credit. Meanwhile, a state council official says the government should improve basic public services for middle, low-income groups and promote the integrated development of urban and rural areas.
Okay, just to pivot very quickly, breaking news right now. I think this is the weekly metric. We're looking at this very closely, obviously on the back of developments in South Korea. So we hit, I think, 16 last week. The week before that's 19. We're now at 11% on the support rating for the president. On the back of all the developments over in South Korea. We'll leave it there for now, but certainly it's still going to be an eventful weekend as we go into that in the next few days or so. Back to China, though. Let's bring in our Chief North Asia correspondent, Stephen Engel, here in Hong Kong for us to wrap what we've heard so far out of Beijing.
Yeah, I mean, a lot of talk, not a lot of specifics. I mean, Annabelle went through that fiscal deficit target, upwards of maybe 4.5. They just said they're going to raise that. I think they're comfortable usually with about 3%. So it does indicate, and they have indicated, that they're going to boost public spending and borrowing as well. But the big emphasis this year, the top priority coming out of the Central Economic Work Conference, is to boost overall domestic demand, so boost consumption. And how are they going to do that? And the devil will be in the details, which we probably won't get, in great detail until the National People's Congress in March, since this is essentially what they did behind closed doors the last couple of days, is set the agenda and set the priorities for that NPC in March, the Lianghui, the 2 sessions. So what do they do? Well, they did talk about some of the drags on consumption, and that is household spending has been pretty weak, largely, too, because of the rising healthcare costs, rising insecurity, lack of confidence. So people have been squirreling away a lot of their money for their own health safety net, their social safety net. And that's something that the work conference talked about. They're going to boost pension support and health care and trying to get the households to feel confident and also spend more. So that's going to be the big driver this year. But not a lot of welfareism coming from Xi Jinping.
Markets like specifics, though. So do we get any sense of clarity on what we can expect in greater detail? The MPC in March seems like quite a long time to wait.
Yeah, you're expecting too much. Details? No.
Well, it's Annabelle.
Look, the Central Economic Work Conference traditionally talks in broad brushstrokes. They set sort of the priority, and the priority of the second time in the last decade is boosting domestic demand. So the details will come over time, and the growth target is one that we do look at, whether it's significant or not, but it does set the priorities and then the marching orders for the provinces and the like to meet that target. And it's probably all indications that we got through the Politburo, through the third plenum, and now the Central Economic Work Conference is that it will again be around 5%. But is that a true representation? Because you remember earlier this month, and also now, he's speaking again, Gao Shanwen, this noted economist in China. He's from, SDIC Securities. He was also formerly an advisor to senior leaders and regulators. He is saying again that the real growth rate is probably not 5.2% that we got in 2023, probably 3 to 4%. And he was speaking in Washington, D.C. at the Peterson Institute, saying it could be as low as 2%. You remember the quote that made waves and was scrubbed from the Chinese internet when he described the Chinese economy post-pandemic. He said it's full of vibrant old people, lifeless young people, and despairing middle-aged people. We're not well, you're not middle-aged. I am well into elderly age. But youth unemployment, 17.1% right now, and they're not necessarily spending.
All right, copying it from both Dave and Steve this morning. But yeah, okay, young people need to spend more. That was sort of what came out of that.
Okay, I'll do it.
I could save questions over Young on that one. Anyway, that was our Chief North Asia correspondent, Stephen Engel there. Let's get to Fred Neumann now, Chief Asia Economist and co-head of Global Research Asia at HSBC. And Fred, what did you make of what we got overnight then from the Central Economic Work Conference?
Well, I would agree, very few specifics, but then again, we never expected specifics at this time. I would say, though, there is an interesting change in language, right? And that's what matters with Beijing, a greater sense of urgency. They're acknowledging the fact that consumer spending is very weak. They're acknowledging the fact that actually price pressures are too low. They want to reflate the economy. So at least we get the right signaling here, which matters a lot in China. But it feels like markets, investors, once bitten, twice shy. They're kind of right now sitting on the sidelines. You saw market reaction being fairly tepid just because we're at a point now where we need more, as you say, specifics. We need to see what's the game plan here. Rhetoric alone doesn't cut it anymore.
What do you think the fiscal deficit's going to be? budget deficit target.
So we heard just now 4 to 4.5% next year. That would, of course, be helpful. But my question is, what is the broader fiscal stance in China? Because, yes, the central government could spend maybe 1.5% more on GDP, right, raising the budget deficit. But what's happening at the local level at the same time? Because these are the guys who spend on social security, on infrastructure, right? And if the local governments are still belt-tightening, you're kind of pushing on a string. So it's really the broader package that matters here. And the other thing is we are seeing still a negative credit impulse. Real rates are rising in China because of deflation or disinflation. And so you need monetary easing on top of everything as well.
They've changed how they describe monetary policy to, I think it's moderately loose.
Yes.
First time since the GFC. When the last time they did that, the 2 years that followed saw just a massive pickup in credit extension and credit demand. Do you think we'll get that this time around, to your point on the credit impulse?
So I don't think they're really shooting for the same boost in credit demand, right? Because that came after the global financial crisis. And there's sort of consensus in Beijing that maybe we overdid it at that point. And back then, I think it was 20% of GDP in new credit that was pumped in.
Yeah, 4 trillion, I believe.
That was massive, right? So this time around, it's going to be not quite that. But we at least need to have the credit impulse be positive. That is, we need positive credit creation relative to GDP. There needs to be net new lending coming into the economy. And that certainly requires lower interest rates, but it also requires, at this point, demand. Right? It requires somebody actually to want to take these loans. And that's where we come back to fiscal policy. So you kind of need monetary and fiscal policy work in conjunction here. And I think the encouraging news from the Central Economic World Conference was that you get a hint that actually they're pushing all levers now. And that's sort of, to me, the silver lining here.
You need that perception shift. You've got to have people that actually, to your point, want to actually borrow the money. And linking that back then to what you were saying about local governments who have been a little bit cautious to spend in the past. Maybe they're worried about doing the wrong thing, for instance, and risking the ire of Beijing. Do you see that changing at all?
Well, that's the big hope, right? Are the local governments, are they changing? And sort of we had the debt swap, for example, which should in theory help local governments a little bit. But there's such a revenue shortfall at the local level that there's very little money left, to be honest. We need fiscal transfers from the central government to local governments. And the reason why local governments are in such dire straits is because the huge revenue source, land sales, has broken away. And it hasn't just broken away for 1 year or 2 years. It's structurally weaker. So we need to fill this gap somehow, not just for 1 year, but for the next few years. And how we do that, that's not entirely clear yet.
But how could they do that then? I mean, if it's not clear, are there any ideas as to how they could go about doing it?
So in the short term, it must be fiscal transfers from Beijing. And so it must be Beijing helping them to raise money, to transfer grants, or to help them raise bonds, for example, guaranteed bonds. In the long term, it really requires them to be able to raise their own revenues, that is, to raise taxes. Now, that doesn't help in the next year if you want to boost growth, but kind of you need to have that over time. And then property taxes, we've talked about this for, as long as I've been, looking at China. Not sure that's going to come, but there needs to be some sort of a revenue raising effort for local governments.
What about more extraordinary measures? Say some version of QE or some version of consumption vouchers. Are we nearing a point that might be more than a sort of tail consideration here?
Yeah, I think particularly consumption vouchers, I think that's on the table. We certainly have the trade-in programs, and from white good trade-in programs, where you can buy a discounted washing machine to a spending voucher. It's not a big jump, to be honest. So I think that is on the table. Whether we get QE, that's interesting, because they're putting in the tools to actually start to be able to buy bonds, but they haven't really, on a net basis, really expanded that purchase enough for us to call it QE. But one or 2 years down the road, I wouldn't rule out that they might actually step up the bond purchase program, and you might call this quantitative easing, at some point, but probably not over the next year or so.
That trade-in program, we've heard quite a lot about it. Do you think it's actually having a positive consequence so far?
It does. So if you look at some of the numbers, so for example, retail sales of white goods or home appliances, they've skyrocketed actually. And that obviously helps factories that produce these goods. The problem is they're too small in scale yet to really turn the needle for overall spending. So we see that in the microdata that really makes a difference. So I would say scale it up. That would make a big difference. The one risk with these programs is that you bring future spending into the present. And then what happens after, these programs roll off, when everybody has a washing machine, then you buy a second one, that's a harder sell.
Well, there's always an upgrade anyway to the current hardware, right? The next one's probably going to have a better dryer or something. Anyway, Fred stays with us. Lots more to talk about with Fred Neumann out of HSBC. We're just getting the reference rate of the day just out. We're looking at the estimates. Okay, 727.32, 718. 76, 900 or so pips. That's quite a big gap there. Not quite 1,000 just yet, but still some support coming through there as far anchoring as far as the currency is concerned. We'll talk about the currency, tariffs, and what that means for the rest of Asia with Fred, of course, in the next few minutes or so. In the meantime, though, just to tell you what's coming up as well here on shows, more analysis on the stimulus plans, as the outlook for the central bank policy as well. What does it mean for rates? And also FX. Ju Wang joins us at the top of the next hour, counting down to the open of trade, 14 minutes away in Hong Kong, Shanghai, and Shenzhen. This is The China Show. Good morning. Just a glance at Korean markets, almost 90 minutes into the session there. The latest news here is the unsurprisingly sort of the support rating for the president is down to a record low of 11% going into a weekend of uncertainty.
Yeah, that's right. We've got him facing a second impeachment motion. It certainly does seem like politicians there in the ruling PPP are also shifting their stance, but it's that question as to why they've really been avoiding impeaching him, and that could also be to protect their own political futures as well. Yeah,
well, yeah, keep them in place. And as that's going on, the BOK is having to figure stuff out. I think they've cut twice in a row. They flagged before all this happened potentially another one within the next 3 months. So that sort of takes you through early meetings next year. So I guess what are they going to do with that information?
Yeah, and certainly we've had them really making that stance for stability in the markets, even though you're really not seeing them recover as much as they've lost, certainly since all of this political turmoil started. But let's bring back Fred Neumann now, Chief Asia Economist and co-head of Global Research Asia at HSBC. And do you see any sort of bearing from this political turmoil on the direction of the BOK?
Potentially, yes. I mean, the first thing is when you have a situation like this, as a central banker, you make sure there's liquidity in the market, right? That's the first job of a central bank, to make sure, and they've done it very well. They pumped in liquidity and stabilized things. Whether you cut rates, it's really a question whether you think this uncertainty continues for a long time or whether that's short-lived. Right, and so if you have now another failure of the impeachment over the weekend, and so this drags out for several months and nothing happens on the fiscal side, then the case for additional rate cuts rises quite quickly. But you also have another scenario where maybe there's a quick new election and we get a new president. He comes in with a big mandate and big fiscal package, and confidence rebounds, and then you don't want to overcut too much. So that's why the rate cut themselves, you hold a little bit in your back pocket and you kind of wait for things how they play out. So an emergency cut doesn't seem likely here. I think they're going to wait for the next meetings next year and then kind of see where they're then. But generally, there's still, even before this happened, a lot of downside pressures on the economy, right? So the trade outlook doesn't look that great at the moment, particularly with what's happening in the U.S. And you got domestic demand was already weak. So, yeah, there's still case for more easing to come.
How closely do you think the BOK is watching how China responds to tariffs and what that might mean for, if we get worst case, we get a dollar China at 8, for example, what does it mean for their currency? How do they figure all these moving parts out?
Oh, very much. They're going to be all over looking at exactly what is China's response to the U.S. tariffs. If the currency goes weaker, the Chinese currency, of course, that would put also a damper on all Asian currencies, pull them lower as well. And that means ultimately that you have more imported inflation. You take that into account. On the other hand, you also don't want your currency to strengthen too much. So that is the case for rate cuts. So you have inflation. You want probably the currency to weaken as well. So it's going to be a tricky path. I think ultimately a weaker currency, Chinese currency, means more rate cuts elsewhere in Asia because they just got to keep pace with the Chinese renminbi. Otherwise, they're pricing themselves out of the market. So it's going to be the renminbi is really the pace setter for all of Asia when it comes to FX.
What about the BOJ? We had the Tankan survey coming out this morning. Mood seems a little bit mixed.
It's a bit mixed. Some of the headline stuff was okay. Some of the details maybe not quite as reassuring. Now, the market's been all over the place with pricing for next week, right? It's been very volatile. Actually, the market's very thin, so I wouldn't put too much attention to that. We expect them actually to come in with a hike next week, and that's because they like to surprise. And so if I hear the market is pricing it out, I'm actually thinking they'll sneak it in. Remember, we had how many times have we talked about BOJ surprise around Christmas, right? So here we are again. So we're likely going to get a BOJ hike because guess what? The economy is doing well. The currency is weakening again. It's past 152. And for the BOJ, the more the currency weakens, you want to kind of lean into that with rate hikes because nobody wants to see in Japan at this point dollar yen at 160. So that's why weaker currency, better growth numbers, and nobody expecting a rate hike. To me, that's 3 boxes ticked for next week for a rate hike.
Just very quickly, how high can they get in this cycle, you think? So let's say they do 1, how much more do we have?
Oh, easily 1%.
Okay.
1%. So could even go slightly higher than that. Remember, real interest rates are deeply negative in Japan right now because they have inflation. So actually, they're running negative real interest rates they haven't run for decades. So monetary policy from that perspective is looser than it's ever been. And the currency keeps weakening. So you may as well put in a few rate hikes, and we're quickly at 1%. And because the rest of the world is not really cutting, Japan still has super low rates, and so we're looking at actual interest rates in Japan. Yeah. It's the first time in my career I get to say this.
Yeah, who would have thought? There we go. Fred, thank you so much. Fred Neumann, have a great new year ahead. We'll see you in the new year. Fred Neumann, their Chief Asia Economist. Go ahead, Global Research at HSBC. Hang Seng Index is called lower, 0.8% going into the Friday session. Right, welcome back. Just over 3 minutes away from the opening bell. Futures are called lower. Initial pricing is lower. We're coming off, of course, a fairly strong rally on Thursday, so that's looking short-lived. We have more information now out of Beijing on what the March meeting looks like, and certainly I guess the question for investors is how do you trade these next few months or so. CSI 304,000 right now. Do we close above that? We've managed to claw our way back above the 50-day moving averages, particularly as you look at the Hong Kong benchmarks. Do we close above those levels is the key question, and then I guess next week is another matter altogether. The open is next.
Welcome back. You're watching The China Show. Counting down to the start of trade here. We've had more details coming out overnight on the Central Economic Work Conference. You've got policymakers that are saying, yeah, we could lift the fiscal deficit. They're looking at ways to try and boost consumption. Question is, really, we haven't got the clarity, the details just yet. Is this going to be enough to tide investors over for a while?
Yeah, no, it's not. Likely no. You look at the equity markets at least, right? It's enough really when you look at the bond markets to continue this rally so far. I think we did the math. 80% of weeks in 2024, we are 50 weeks in that we've seen Chinese bonds, the Treasury index that we track at Bloomberg, clock in a weekly gain. So I think that's really a trend that continues to remain strong. Plus, it's Friday the 13th, don't forget. So we could get something, not because it's Friday the 13th, something later today. I think Citi flagged the possibility of getting a triple R cut as soon as Friday. The credit numbers are perhaps on deck as we go into the weekend. 0.7% to the downside on the CSI 300. Mind you, most of these things were green going into the close. Very strong session, very strong turnover. Thursday session, so we're giving back some of that in the early goings today. We're still at about 1 month highs, though. You look at the benchmarks here. Hong Kong, the story here is HSBC, actually. So the FT is reporting that HSBC is reviewing its retail banking outside sort of their key markets of the UK and also Hong Kong. I tell you what they should be reviewing is how to shorten these lines in the retail banking branches here in Hong Kong. Spent the better part of 90 minutes this week. Anyway, looking at these Morgan Stanley calls on some of the property developers in Hong Kong, so Hysan Development, Wharf downgraded to underweight at Morgan Stanley, and some of the big winners yesterday are clocking in some losses today, like Budweiser Brewing and Haidilao, which were a bit up yesterday, are seeing some money being taken off the table, profit-taking, as we say. Okay, for more on the equity markets and the government's pledge to boost consumption, let's bring in our Asia equities reporter, Charlotte Yang, to talk us through this, the investor reaction. Yesterday or today?
I think today,
okay, yeah.
So I think, what we're seeing at the open as well, I think some of the short-term investors, they could be, in this behavior of selling after fact, given we had a strong session into yesterday. But I think what, our sense with the investors that with a longer-term horizon is that they are getting more confidence now that we have the affirmation from the Central Economic Work Conference that there is going to be a progress stance into next year. And what they particularly like, I think, is about this emphasis of lifting consumption vigorously, given that consumption has been the weakest link in the economy so far. But with that said, there could still be volatility given that, the CWC is not the venue for details or numbers. So we will only be getting more details in terms of, for example, the economic growth target into next year at March. So there will be that period of volatility for the equities market.
One name that sort of withstood that volatility to have a really stunning rally has been Xiaomi, and part of that is the EV story, it seems.
Yeah, Xiaomi is such a bright spot this year. And, it's so impressive if you think about it. Even in the most competitive sector, the Chinese EV sector, they can be still a star of dark horse. And that's what's happening with Xiaomi this year. The stock has gained more than 100%. It's now just 10% away from a record high achieved in 2021. And I think what really surprised investors is that nobody thought they could make it in the EV, but just like how it cracked into this smartphone market, it's doing it again in the EV, thanks to its strengths in marketing as well as supply chain abilities of ramping up deliveries. So the next thing to watch for this stock is the second model into next year, this SUV model.
Okay.
All right. That was our Bloomberg Asia Equities reporter, Charlotte Yang, there. And other corporate stories that we're tracking this morning, Google and Samsung have partnered to create a new operating system and headset for the mixed reality market. That's going to be challenging devices that we've seen from Apple and Meta. The new version of Android's operating system is designed for extended reality. The Samsung-built headset is codenamed Muhan, which is Korean for infinity. That's set to debut sometime next year. HSBC is reportedly reviewing its retail banking operations outside the UK and Hong Kong. That's according to the Financial Times, which also reports the bank would scale back operations in Mexico. Sources say the FT spoke with HSBC and it's looking to focus on wealthier, premier clients. Bloomberg has learned that China's Instagram-style app Xiaohongshu has told investors it's on track to double profits this year to over $1 billion. The strong results are likely to revive speculation about an IPO. Xiaohongshu has grown rapidly to 300 million monthly active users, partly at the expense of Alibaba and JD.com. We'll have plenty more ahead. This is Bloomberg.
Wednesday, The Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's pretty high bar.
All of this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
CBS News is reporting that Chinese President Xi Jinping is likely to decline Donald Trump's invitation to next month's inauguration in Washington. Our Asia government and economy correspondent Rebecca Chung-Wilkins is with us. And, I mean, is that any surprise, really?
I don't think so. I mean, just to put it in context, it would have been really very abnormal to have any foreign leader going and attending this inauguration. For context, we might see someone, there's still a potential, but I don't think it's a surprise that we're not seeing President Xi going. For one thing, it doesn't really sort of follow protocol. The protocol now would actually be perhaps for the US president to be taking a visit to China. So that might be on the cards. But there's also very little to gain for Xi here. I do think it's interesting that we are seeing a sort of host of these dovish signals from Trump here. You think about the appointment of Bessent as Treasury Chief. You think about Elon, of course, we knew about, but that appointment of Perdue to the US ambassador role. In some ways, we're going back to the norm here, appointing someone with deep sort of history and business ties to Asia, to China. He's someone that's familiar with Chinese officials, has worked with them in the past. So from that context, it's interesting to see, Trump kind of, it's not an olive branch per se, but somewhat tilting a little bit more friendly. Just as China itself, it seems to be sort of flexing its muscles a little bit, sharpening its swords a little bit when it comes to anticipating this looming trade war.
Yeah, I forget who the analyst was, and my apologies, but I think they made a very good comment. I think I saw it on LinkedIn, that, the Chinese have always wanted to be seen as equals. And I think this was a really good move, according to the analysts, from Donald Trump to at least send that signal through. The reason I bring that up is it doesn't mean, there isn't anything to talk about. I think President Xi Jinping did say that the two should focus on talks and not confrontation here.
Yeah, absolutely. And as you say, quite a savvy move from President Trump, or incoming President Trump, rather, like totally understanding what is needed to try and break the ice or try and sort of change the nature and momentum of US-China ties. I think there might even be some frustration on the part of Beijing that it's difficult for them to react very sort of impromptu in this way that Trump sometimes likes, but that doesn't mean they don't recognise, and they can't reciprocate perhaps, but doesn't mean they don't recognise the value of these kind of outreach attempts. As you say, David, we did have these comments from President Xi Jinping reiterating his desire to keep ties open, to keep talking with the US. That actually is a sort of reiteration of comments we had out of the Commerce Department, and we do have these comments quite often coming from Chinese officials maintaining that the US and China need to manage their differences. They want to have more dialogue, not less. And so in some ways, we sort of have this sort of quite happy, friendly, nice talk going on. But on the other side, of course, we still have this probe into NVIDIA. We have China trying to make some of those export curbs extraterritorial, taking a book out of the US and European sort of playbook there. We also do see them fully exercising and showcasing perhaps a more moderate or restrained version, but a version of precisely how they could retaliate if we do see really sharp tariffs coming through. If we do see something like a 60%, Beijing has at the same time as maintaining happy sort of and positive tone to their conversations with the US. At the same time, they have continued almost day in, day out to showcase precisely what expanded toolkit they have to push back against potential tariffs.
Okay. Rebecca Chung-Wilkins, thank you so much. I believe you're off, of course, for a few weeks, so we'll see you in the new year.
Yeah.
There we go, our Asia government and economy correspondent. The analyst is Peter Alexander. I mentioned that, of course, a frequent guest of our show. My apologies, but Peter mentioned that as well, the thing I just mentioned. Managing director, of course, is Zeban Advisors. Right, some other stories that we're tracking and following this Friday morning. French President Emmanuel Macron is set to name a new prime minister. That's on Friday after the government of Michel Barnier was ousted last week. National Rally leader Marine Le Pen's decision to join forces with the left to bring down Barnier's government has boosted her ratings. Meanwhile, Macron's popularity is near a record low. Russia is close to an agreement with Syria's new leadership to maintain 2 vital military bases in a Middle East state. Now, sources tell us the Russian Defense Ministry believes it has an informal understanding with the Islamist group known as HTS. Western officials are said to believe that Russian bases could act as a deterrent to extremism in Syria.
Well, we've got something of a milestone this morning in Sydney.
Well,
actually, it's just gone noon, but we've had an IPO or a listing, a trading debut for a company called DigiCo REIT. This is a data center operator, and they actually raised $2 billion, that's Aussie $1 billion, in their IPO. It's 1.3 billion US dollars. That is sort of what we're seeing as it comes online this morning. So it's wavering. It's not doing... you can't say that's a stunning debut, but still it is the largest deal that we've seen in over 6 years and has boosted Australia's overall IPO proceeds this year to $2.4 billion. That's really, that's the major one that's making up that total there. Still in the sort of AI-linked play, we can also take a look at what's happening with Broadcom this morning, or Broadcom-linked suppliers in Asia. So that's what we saw in late trade there. Today we're seeing some of the suppliers as well moving mostly to the upside. But Broadcom, of course, what really led into those big sales gains was the predictions they had around their AI product sales. And so they're saying that they could grow 65% in the fiscal first quarter. This is a company that we know as a supplier to Apple, but this is sort of their second play and really what is a developing part of the business.
Yeah, 2 additional hyperscaler customers for AI chips, specifically to Belle's point. They do see revenue from those new customers coming through before 2027. The market's really latching on to not so much the Apple story, which is actually, there's a separate conversation around that too, because there's an Apple story that's out on that. But yes, on the new hyperscalers, looking at the market for that specifically, 15 to 20 billion over the next year. So there is a number that investors are latching onto here. And I would imagine this is a stock, if not the stock to watch when the U.S. opens up, of course, on Friday.
Yeah, very significant rally. And I think because we actually had seen that stock under pressure, to your point, on the Apple news, because we've had that scoop out from Mark Gurman saying that they're nearing a switch away from Broadcom for a key wireless chip. And that has sort of been the play of Apple to go in-house and go it alone once they reach a certain level of capability in a particular space, any given domain. So we did see Broadcom under pressure. But, of course, after those earnings, big gain in late trade. But we'll have plenty more ahead. This is Bloomberg.
From Lan Kwai Fong, the area that I control, it's a different change. We were mostly expat in the past, but during COVID, 200,000 people of expats left Hong Kong because they didn't want their children to do online learning and 21-day quarantine, all that, and many did not come back. And so that changed, and then, of course, 150,000 locals got B&O passports. They went to the UK. Yeah. So that changed the dynamics. I've got a Michelin star restaurant, one Michelin star restaurant, Chengdu from Sichuan, from Chengdu, Sichuan. I've got Meike TV, which is a public company. They have 500 in China, and they've got it's publicly listed in China. Very, very popular. First one going to be in Lan Kwai Fong. All the newspapers, everybody's very excited about that. I've got Chao Chen Men, which is a hot pot restaurant from Chongqing, and these are all new imports. I've got more coming on the way.
That was Lan Kwai Fong chairman or group chairman Alan Zeman talking to us recently about some of the changes happening in the Hong Kong dining and drinking club hub, rather, Lan Kwai Fong. But the area in Hong Kong, not too far from here actually, undergoing a facelift as that part of the city tries to cater to an influx of visitors and residents from mainland China. That customer base, maybe it's replacing some of the expats who left during COVID, but let's get more from our Bloomberg conglomerates and media reporter Shirley Zhao. And Shirley, I mean, I think for anyone who's in the city, everyone can see the changes in LKF. But just for people that are outside, what are we seeing exactly?
So Lan Kwai Fong used to be focusing very heavily on expat and local professional customers, and that's because of its location. It's right in the middle of Central, which is Hong Kong's business and finance hub. It's full of big international law firms, banks, and big international brands, and that's attracted a lot of expats and upper middle class local elites to the area to have some drinks after sealing deals. But after COVID, we've seen a lot of legacy bars and establishments closing down in Lan Kwai Fong, and replacing them are a lot of mainland brands, as we've seen, like Alan Zeman, who's the biggest landlord in Lan Kwai Fong, just said. He mentioned in an interview with us that there is a Chongqing hot pot place which opened in Lan Kwai Fong in April, and then there will be a Chinese karaoke place opening in Lan Kwai Fong later this month. And he's also in talks with other mainland Chinese brands, including Luckin Coffee, to set up shop in Lan Kwai Fong. So that's a rare sight to see in the past, because expats are not into karaoke. You don't know that.
Well, clearly someone is.
Well, it's more of an Asian thing, yeah. I think.
There is actually, and the insiders will know this, there is one specific hot pot place in LKF that also does karaoke. But it'll go unnamed, and I can see you nodding. Yeah,
that's the Chongqing hot pot place, Chao Tianmen, which opened in April.
There we go. Yeah. Singing with Mala.
Yes.
It's not just LKF, right? I think LKF is symbolic. I think the changes there of what we're seeing across the broader F&B space in many parts of Hong Kong.
Yes. So it really shows that Hong Kong is shifting from being the sort of regional or global financial hub to China's financial hub. And that's got a lot to do with the past few years where Hong Kong experienced months of social unrest and then 3 years of COVID closure. And during this period, a lot of expats and local professionals left Hong Kong. And to replace them or to attract more talent, the Hong Kong government introduced this top talent visa scheme, as well as a lot of other measures to attract talents. And so far, what we've seen is that these measures have mainly attracted mainland Chinese people to come to Hong Kong to work. And that's shifted Hong Kong's demographics a lot, and that's leading to Hong Kong's whole shift into relying more and more on mainland Chinese customers as well as mainland Chinese talents.
And is that the businesses that are slowly starting to cater to the changing profile, say, of the work demographic in Hong Kong, and also the changes we're seeing in consumer habits, right? People are going over the weekend across the border.
Yes.
What does that mean for the net outlook for the rental market in Hong Kong?
So in terms of retail and office rents, what we've seen right now, Hong Kong is facing the challenges of high interest rate and an oversupply of units, as well as home market as well. So Bloomberg Intelligence expects that the home market to recover about 10% next year, but that's still far from what we've seen a few years ago. And Hong Kong's home prices right now is near an 8-year low. And in terms of retail and offices, the challenges are even bigger. And Morgan Stanley just had a note saying that they expect that next year the rental and retail and office rental market to continue to drop for about 5%. So I think it will take a long time for Hong Kong's property market to recover in this broader China economic slowdown and property market downturn.
Shirley, thank you so much. Shirley Zhao, our Bloomberg Conglomerates and Media reporter. Let's, if you want to see that story and the other major pieces of news, of course, across Hong Kong, we have an insider's guide, of course, to everything, money, people, and everything in between, shaking up the finance hub in our Hong Kong edition newsletter. It's out every Thursday. So you can sign up via Bloomberg.com/newsletters. Okay, let's start things off with a check of the market pulse here with some of the gold mining stocks, and we're pulling back a little bit right now, and I would imagine this is really on the back of a pullback, roughly, in gold prices these last 24 hours or so. So everything from Jiaojin mining, which I believe is the biggest one, or Zijin mining is actually one of the bigger ones too, all the way across, and not just in Chinese markets, but as you can see, right across some of the other names traded just about across the region here as well. The other thing that we're talking about too is the Chinese 10-year yield. There we go. We've now dipped below and you're looking at the yield here. Well, futures are pointing at a 102, so we're higher on that, and it's unrelenting rally taking us to 1.77% here, Belle, on the 10-year yield.
Yeah, just a really stunning retreat that we've seen really over quite a period now. But broadly, what we're seeing in the markets today is, wow, the CSI 300 is not, that's probably not the reaction that policymakers want to see.
No, but it's not surprising to see it, though, as well, given I think the lack of, the big bazooka number, and that might actually come in the form of a larger fiscal deficit number, which comes, of course, in March. But also, I think what seems lost, in my opinion, when you look at how investors are reacting to this is a multi-year approach, right? So the numbers we hear, 10 to 12 trillion, I think was the note from HSBC, is that's going to be sprinkled across many years, and I don't think they even know how they're going to spend that. They know what the room is like, but we don't know what tariffs are going to look like. We don't know how the economy is going to respond. But I think what's clear is that their intention to keep on this until they see the economy respond, I think, is what's key here longer term. Now, how do you trade that short term is unclear. How you trade it longer term, I guess, is this a value opportunity or a value trap? Anyway.
Big question. And just to note as well, we have had some central bank activity as well, because you've got the BOJ coming up next week. We just had the Tankan survey out this morning. Business sentiment is looking a little bit upbeat, so it could put us up for a hike possibly. That's what HSBC is saying. And the ECB as well, heard from them overnight saying that they're prepared for 2 quarter-point rate cuts over the next couple of meetings as well. But that's it for this hour of the China Show. Stay with us because we've got plenty more ahead. This is Bloomberg.
Property market is not recovering, then the credit growth through the property sector as it used to be cannot be regenerated either. Right? So even if you cut triple R, probably before the year end we'll see another 50 bips triple R cut, and probably next year we're probably going to see 100 basis point interest rate cut. But I think this policy has proven to be sort of futile to lift the Chinese economy, and therefore more unconventional policies needs to be done.
Chinese national debt is relatively low by global standards. It's about 100%, I think, mostly local government debt. And that debt was accumulated for investment, not for consumption. That's where China is more resilient. Whenever the global situation becomes too complicated, they always can run up the national debt a bit to help stabilize the economy.
They're putting in the tools to actually start to be able to buy bonds, but they haven't really, on a net basis, really expanded that purchase enough for us to call it QE. But one or 2 years down the road, I wouldn't rule out that they might actually step up the bond purchase program, and you might call this quantitative easing, at some point, but probably not over the next year or so.
There were some of our guests early this morning on Bloomberg reacting to China's signals of increased borrowing and spending for next year. You're watching the China Show and taking a look at the CSI 300 half an hour into the session. So far, we're at intraday lows, sliding really in tandem with what we're seeing with bond yields as well. CGB's pulling back, but it really is the reaction to the Central Economic Work Conference and investors also being left a little bit disappointed because of the lack of specifics. That hasn't hasn't stopped, though, local media, of course, talking about this. And we've seen, for instance, an economist writing for Xinhua Finance that the government could raise the fiscal deficit next year to a range of 4 to 4.5%. That's Liang Ping of the Guangkai Chief Industry Research Institute, who says an increase doesn't carry too much risk considering China's finances and its debt levels. He says the fiscal deficit has remained at a relatively low level for too long. Experts are also weighing in on how China can stimulate domestic consumption. That really is the key talking point. One analyst telling the Securities Journal that monetary policy will play a key role by supporting consumer credit. Meanwhile, a state council official says the government should improve basic public services for middle, low-income groups and promote integrated development of rural and urban areas.
Yeah, and really I think one of the stories that Belle was just pointing out there, right? So is 3 to 4% growth such a bad thing if it's quality growth? That's point number one, right? What we're seeing now, and the two major policy pivots from September and the latest one out of the Politburo again early this week, pointing to maybe just a statement, an observation, a fact that the economy's not doing well. I know that's almost stating the obvious, right? So we're looking at a measure here of, this is a 6-month moving average of, this amalgamation of bank lending, railway activity, and electricity or power consumption. And that's trending at about 4% or just above 4%. The 6-month average is at 4.7%. So if you compare that to the actual growth, and I know other things go into the actual growth figure as well, that's coming in subpar. Point number two, though, is given what we've seen recently, our Bloomberg Economics Nowcast model, which effectively takes high-frequency data and extrapolates that ahead of the official release of GDP numbers, does point to currently, and this changes day to day, and there is some variance depending on the data, of course, currently at about 5%, a rebound for this quarter. So that's almost the silver lining if things continue, but certainly the hole that we need to dig ourselves out of is quite deep on the former chart. Bloomberg Economics, speaking of, out with their initial reaction to the document, of course, that came out of Beijing yesterday on what came out of that. And effectively, there's no big surprise coming through there. It is indicative, of course, of economic support moving forward. And, Bill, I should also note, while our viewers read this, Citi came out with a note just this morning talking about how a RRR cut could come as early as today, speaking of policy support. Bill.
Well, that's it. There might have been no surprises, but what's been really well and truly reinforced is this idea that we are going to see easing for China next year, and that as well being reflected what you've got in CJB's this morning, sliding below that 1.8% mark. We have never seen that either for China's 10-year bonds, government bonds. So let's get more on that now. Bring in Ju Wang, head of Greater China FX and Rate Strategy at BNP Paribas. And how low can we go, do you think?
I think as we're heading towards 2025, there's a chance of a 10-year testing 1.5 this time. We definitely see signals from the Politburo meeting and the CEWC that policies are turning more decisively pro-growth into 2025. And on the monetary policy side, they adopt this word approximately loose, which is a wording that they haven't used since 2009, 2010. So market read it, that's a clear sign that they're going to cut RRR, cut policy rates, and the short-term policy rates is definitely heading towards 1% handle. So that means the long end, for example, the 10-year probably eventually yields can reach level close to 1.5% in our view.
Do you think between the current level, let's say 1.8% and 1.5%, how do I trade that? And do we expect either intervention or pushback, similar to what we saw, I think, a few months ago when the rates were testing the 2% level?
I think since they changed the wording for the monetary policy framework from previously prudent to approximately loose, and I think the policy tolerance towards the lower yields will be larger than before. So I wouldn't take 1.8 as a policy floor anymore. If one short end is heading towards 1%, long end, yes, 10-year can go to 1.5.
The last time we saw the PBOC adopting a moderately loose moderately loose policy stance was in response to the financial crisis. So it's quite a long period of time now. At that point in time, though, they did have more room to ease. What do you see this time around?
I mean, back then, obviously, China had a lot of room to ease, but also importantly, back then, they adopt a very aggressive credit push, right? That's 4 trillion stimulus, eventually resulting in a very sharp and quick rebound in the credit growth and lift out the growth in 2009, 2010. This time, I think, despite of they're adopting the same wording and they're turning more pro-growth, but the growth model will be very different from 2009 and 2010. This time for us is more of there's still a balance focus between quality of growth and quantity of growth. And definitely the driver of growth will be high-end manufacturing, consumptions. And this time we are seeing a bit more decisive push for the capital market gains. They mentioned about flooring the property price as well as the equity market. So I think we will see a different, slightly different result compared to 2009, 2010.
All right, Ju Wang, stay with us. That's Ju Wang, their head of Greater China FX and rate strategy at BNP Paribas. We, of course, track what's happening in China government debt this morning. We're seeing yields here that are just pretty much retreating across the board. But importantly, the 10-year yield falling below 1.8% for the first time ever.
Yeah, and I think the point, too, that everyone talks about quality growth, and Ju Wang will be rejoining us in a couple of minutes, too, is what does it mean for the inflation picture in China, right? Because that goes into earnings, the equity market, and really where bond yields go. In case you missed that milestone, I think it was 3 or 4 weeks back, the 30-year yield in China actually fell below Japan's for the first time also on record. And as you can see on your screens, 2% is effectively an afternoon away if this continues on the 30-year yield. So bonds are bid, the equity markets are offered up in China, the currency's on weaker footing of late. Plenty more ahead. This is Bloomberg. All right, we're 40 minutes into the cash market session, about 2 hours away from the lunch break in Hong Kong. So we'll see what the afternoon holds. But before we get to that, I mean, certainly the trend on the equity market is we're giving up part of most of the gains we had yesterday. It's point number one. Point number two is the fix coming in again this time in the last hour, again on the stronger side. In fact, it's been on the stronger side of the recent stronger sides, plural. 856 pips stronger than the estimate. So again, this sort of anchoring or leaning into the weakness coming through. What's the currency doing? Can we show that as well so our viewers can see that? On the offshore rate, we're trading at about 727-ish, and the onshore rate, and what you don't see actually is when you take the spread between the forwards of the offshore and the onshore, that is indicative of market expectations of more weakness coming ahead going into next year. Do we have the currency, please, to show our viewers? No. We'll show that to you in a moment. Let's get the projection, though, from Ju Wang, head of Greater China FX and rate strategy at BNP Paribas. I feel we've been going back and forth on how weak the currency can get next year. Let me start off, though, by asking not a specific level. There's been talk this week in officials, you might have seen that media report, that they might let it weaken. So a managed depreciation of the currency, let's put it that way, to a one-off devaluation. We might be closer to what next year?
We expect the RMB to rise towards 750.
Okay.
By end of 2026. So essentially, that's a response towards the potential upcoming tariffs from the U.S. New administration. We are in the camp that if there's a tariff, China will let the currency adjust. But there will be also counter measures to prevent the currency from weakening too much. To be honest, from current level towards 750, that's still a very measured adjustment against our center case of a tariff of about 25%.
Is it the actual level of the currency that matters, or is it the way that it gets there?
The actual level of currency is important because RMB is not only important for the Chinese domestic participants, but it's also a very important anchor for emerging market currency. I would say 750 is actually a political correct number for all stakeholders.
Well, it's almost like 160 on dollar yen. Well, my question is, as we try and figure out, so it's not just a trade ongoing long dollar China, right? People are trying to figure out what other Asian currencies might be most at risk if we get to 750 or even beyond on dollar China. How do you look at this list of this complex of Asian FX, for example, and figure out which ones are most vulnerable to yuan weakness?
Well, from a gross link perspective, the ones with more export exposures will suffer more. So, for example, Korean won is very sensitive towards the RMB move. The ones are more reliant on domestic demand, like India, IDR, probably are more shielded. But there's some second round of complication, right? In knowing the tariffs are going to come, the Chinese corporates are going to invest more into Southeast Asia economies, and we're already seeing Thailand and Malaysia receiving good amount of FDIs in recent months, and that will partially shield this tariff shock. But essentially, we think Thai baht and Korean won will be, and Taiwan dollar, or these will all be sensitive towards RMB weakness.
So is that sort of how you want to look at it then? Not so much what the dollar yuan is doing, but it's what or how much officials allow the yuan to devalue versus the basket of currencies in this region?
Yes, I don't think they really track the RMB versus the region's currency that closely. Of course, if the euro is heading towards parity, which is our house view for 2025, that's definitely raised the pressure for China to allow the RMB to adjust, because euro is a very big component of the DXY basket. But in general, I think the approach is they will have to respect the market force, which is if there's a tariff, the currency needs to adjust. But at the same time, given the fact that China is now running nearly 1 trillion trade surplus a year, US dollar terms, so there is a room for them to maneuver, to decide the scale of adjustment. And as I mentioned, right, so to make everyone happy. So 750 is the politically right number in our view.
The other number I'm working with right now is 2.5 percentage points. That's the spread between the U.S. 10-year yield and the Chinese 10-year yield. I don't think we've ever been this wide, at least in 20 years. What are the major implications of that? Because that doesn't go away very, very quickly.
Yeah, that's definitely still keep the carry trades in place for dollar RMB. Same story can be said for most of the Asia low-yielding currencies. So unless Fed is going to enter into a very aggressive easing cycle, this is not going to go away. So the dollar will still catch a bit from this region's demand for carry. But I have to say, nominal yields is important for carry, but there's also something called real rates and trade surplus, right? From a real rates perspective, the renminbi is still quite decent. And no doubt the capacity side, manufacturing capacity is still very, very competitive, right? So trade surplus is so big. So we have to factor into all these things to decide where the exchange rate goes. But the record yield differential between U.S. and China clearly suggests that the U.S. is still facing inflationary pressure, while China is addressing domestic deflationary pressure.
Do you see any end to the deflationary pressures in China, and if so, when?
I do think the Politburo meeting and the CWEC have sent a stronger message. They're trying to prevent the deflationary force to go deeper. So they're going to adopt a more accommodating monetary policy. Fiscal deficit will widen further. They're also adopting consumption, property, equity market friendly measures coming to 2025. However, we don't think it's a bazooka yet. It still takes some time for the economy to find a natural floor. Inflation goes up, it takes some time as well. The financial condition will definitely be looser into 2025, as we're going to see 1% policy policy rates in the short end, and
wow.
Well, so that's interesting, in the way that if the China's yields are heading towards 1%, then eventually this massive saving sitting the domestic financial system will inevitably either go to overseas to seek for carry or allocate more to high yielding assets, which is the equity market in China.
So among the many opportunities that you laid out there, what's the single best trade? Let's leave our viewers with something that they can make money on. Single best trade in China next year?
I think it's still long bonds, long equity overlaid with a long dollar renminbi.
Perfect. There we go. Ju Wang, fantastic. Thank you so much. Head of Greater China FX and Rate Strategy at BNP Paribas. Right, dollar is slightly bids. The rest of the Asian equity FX complex is on offer this Friday. Full market wrap is coming up ahead. This is Bloomberg. Right, welcome back to shows. So South Korea, big weekend again coming up. So you have the president's approval rating. Unsurprisingly, came out about an hour back, lowest level since he took office, 11% in this Gallup Korea poll. Meanwhile, you have the opposition filing the second impeachment motion against him, really setting us up for another potent next few days or so. Sang-mi Cha, our reporter, joins us out of Seoul to give us a preview, Sang-mi, of what exactly is in store this weekend.
The newest news is his approval rating sliding to its lowest to 11%. The lowest for any Korean president so far was 5% for the already impeached ex-president Park Geun-hye back then. So we still see that number is not near that levels. But again, that's quite of a downgrade from 5% from last week. And the survey is showing us that it happened after the opposition bloc filed that second impeachment motion against Yoon yesterday. And where that happened actually after President Yoon made a defiant speech where he tried to justify his martial law order last week, where he insisted that he would fight against any cases that comes against him. And it seems like his bid to turn public sentiment against the opposition may fail to garner traction with the members of his own party turning on him, though, because as we know this by now, the opposition needs to secure 200 votes in a 300-seat parliament to pass that motion. But an attempt to impeach Yoon last Saturday failed to reach that after the party boycotted the vote. So we'll be watching whether that will repeat itself or more of his party lawmakers will come out and vote against him. What the opposition needs right now is just one People Power Party lawmaker to join them to impeach the president, as they need just 8 defection from the ruling party. So Saturday after the vote, we'll be watching this very carefully.
And so it does seem like that case. Yeah, maybe we'll get a different outcome this weekend. But if we do get a different outcome, what happens exactly?
What happens then is that the president is going to have his duties immediately suspended, and it will immediately go to the Constitutional Court, and that will last up to 180 days. And the court then rules against the president. And if the court does that, then he will be forced out of the office, and then it will trigger a presidential election within 60 days. So we're looking at quite a number of months there if the impeachment goes through. And if it doesn't, then we'll have the opposition filing this motion every week, and we might see this repeat every week, pretty much.
All right, that was our Bloomberg reporter there, Sang-mi Cha, and it's also that question of how Korea's regional partners reacting to this news as well. And we actually heard exclusively or spoke exclusively to Akihisa Nakashima, National Security Advisor to Japan's Prime Minister Shigeru Ishiba. He says Tokyo's policy hasn't changed of yet amid the political turmoil in Seoul.
What we're most concerned about is how the situation between Japan and South Korea, or between the U.S. and South Korea, will develop depending on the direction of the South Korean administration. There may be many things going on in South Korea domestically, but since the strategic situation surrounding South Korea hasn't changed, I don't think there is room for major policy changes there, regardless of the administration. I expect continuity.
Right. Now, back to the Chinese markets, what a difference 24 hours makes. In fact, less than that. So at the close yesterday, these names posted substantial gains. As you can see, that's getting taken off the table right now. Broad consumption names, I think, is your common denominator between these names. Everything from Mamnia, which is dairy, of course, takes you into things like booze, Budweiser, APAC. You have travel and services, Trip.com. It's a similar list, in fact, when you look at the names onshore that are getting pummeled, Guizhou Maotai, Luzhou Laojiao, and some of the wine and liquor makers there. The other sector that's seeing some substantial downside in the first hour of trade is property, and it's note out of Goldman Sachs. Same reason, really, on consumption, the lack of concrete details there. And I'm going to read this almost word for word from the Goldman Sachs analysts team here, Li Shangwang. There may be downside from no clear, actionable strategy to stabilize the property sector and normalize inflation. So a Bloomberg gauge of these stocks fell as much as almost 4% at one point. And apart from this, I think one winning pocket of this market has really been bonds, to the point of our earlier guest, BNP. We made her pick. What's the number one trade? CGBs.
Yeah, and she's saying it could actually reach 1.5%, the 10-year yield, but certainly it's got that expression of that further easing to come. And if there's any sort of clarity that we did get out of the CEWC is that, yeah, easing is certainly on the table, and also lifting that fiscal target or fiscal deficit target for next year, maybe up to 4.5%. More ahead. This is Bloomberg.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell. Earnings from Caesars crossing the Bloomberg terminal. Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
It's 11:29 a.m. in Tokyo. Japanese markets just about to go on their lunch break, and you're seeing losses here. The Nikkei 225 down 1.2%. Interesting column out this morning in our Taking Stock Asia. Hideyuki Sano is saying that cheap valuations, they just don't cut it anymore. Actually, investors want to see a significant effort from companies to improve their corporate governance. And certainly, Japan is the case for this region about how to essentially do a value-up program.
Yeah, you're right. And it takes a long time to do that, right? In Japan's
case, a decade in the making in the case of Japan.
Yeah, unless you fire your CEO that's misbehaving, but that doesn't really instill good corporate governance. Anyway, but yes, it's going to take more than cheap. And the Chinese market's a very good example of that, right? In terms of just this market's been very cheap. Korea's been very cheap. And I think Korea is the perfect example, too, of that intersection between those two things. It's cheap because of the need for corporate governance, and that's being put on ice right now. Speaking of how corporates feel optimistic in Japan. 14 on the Tankan survey. We were expecting that at 13. So 14 on the large manufacturing. I know 14 doesn't mean anything in a vacuum, but that's the highest in almost 2 years. And it almost sets up to the point HSBC was making to us earlier in shows. The BOJ is probably going to hike. Don't be surprised if they do.
Yeah, and HSBC was saying that's their case. We actually had a survey out yesterday saying January was what a lot are seeing, but still, I mean, there's enough calls for a move next week.
Yeah, it's almost half banter, right? It's half true, I would say, too. Fred Neumann was joking about this. The BOJ probably looks at what consensus is, and then they do something when it's non-consensus just to sneak in while no one is looking. We're down 1% in the benchmark. We are on track currently for the worst day on price in the equity markets in the Asia-Pacific. S&P futures, we'll get to the Broadcom story in a moment because that's one stock to watch, certainly when you go into the Friday session in the U.S. But broadly speaking, risk is being taken off the table. Every single major sector group in the Asia-Pacific. is lower, and as you can see, the dollar is catching a bid here today.
Yeah, well, I was about to say the exact same thing. It's just red across the screen, and if there were a sector, I mean, the one that's standing out is IT. It's trying to get into positive territory. Tech, it's slightly under pressure this morning. But, I mean, if you looked at the lead-in that we had overnight and the suppliers to Broadcom, of course, Asia is really the AI play with the likes of Taiwan in particular, heavily exposed to that story. Broadcom did very well in after hours today, given the predictions it's making around AI product sales in particular. But let's get more on this now. Bring in our Bloomberg Intelligence senior analyst, Kunjan Sabani, who joins us from San Francisco. So, Kunjan, thanks very much for staying late for us, really. But what did you make of the numbers that we got out earlier?
Yeah, really the star of the show and why you're seeing the stock reaction was this massive SAM of 60 to 90 billion. Just across the 3 top hyperscale customers that it's serving in terms of AI revenues, up from almost 3 to 4x up from where we stand today.
What else stood out to you? There are many lines that came out of that. And I'm sorry, and I also want to ask you about the Apple angle to the story. You know, is the good news enough to offset any potential pullback we might see from Apple as a customer?
Yeah, so other than the SAM, I mean, look, there where everything was right on spot in terms of numbers coming mostly in line for 4Q and 1Q. A few other things that were better than anticipated was the EBITDA margin guide for 1Q, which suggests that the VMware integration and the cost savings are going better than what they had announced. There was also the dividend increase of 11%, which was higher than what we had thought. We expected it to somewhere between mid to high single digits. So that was another, again, positive there. There were some concerns of the AI being lumpy or the timing issues, but I think with the massive AI SAM that they give, all of the concerns would be eased. Finally, on the Apple angle, I mean, look, we have been hearing these news about Apple, designing out Broadcom now for the past 2-3 years. It's never come to fruition, so we don't want to comment on sort of news or rumors. But if that were to eventually happen, we think the total loss of that business maximum, if you lose 100% of Apple, would be somewhere between $2 to $3 billion, which can be easily offset by the new gains that they're expecting to cover in AI through the hyperscalers. And even with the news of Broadcom being the custom design partner for Apple, that revenue itself, that new revenue from Apple itself over the next 3-4 years could be way larger than the loss that they could have potentially if that comes to fruition.
What about Broadcom's software business? This part didn't look quite as strong, perhaps?
I mean, I think most of the attention right now is going to the AI semi revenues. But I mean, look, it is chugging along, right? Even better in terms of milestones and EBITDA margins. So that's really good. I mean, like if you didn't have these AI revenues right now, that we would be paying a lot more attention to that software, which is, again, really doing better than we had expected.
With the new information from Broadcom, Kunjan, how do does this change the way we should be thinking about competition broadly next year?
I mean, look, when you think of the AI custom where Broadcom plays, it's really a duopoly. It's Broadcom and Marvell. So nothing changes there. There could be some changes in terms of market share projections, like Broadcom might increase their share or keep their share the same from what we have heard so far. And the second area that they serve these hyperscalers are the AI networking and connectivity products. Again, sort of a duopoly there between Broadcom and Marvell. So, I mean, at worst case, they maintain their share. At best case, they increase their share. But what really changes is the opportunity size would be increasing after what we heard today.
That was our Bloomberg Intelligence senior analyst, Kunjan Sabani there. And also just taking a look at another sort of AI-linked play this morning. This is DigiCo REIT. I mean, it's unchanged right now, but it's actually better from where we've been throughout the session because it was earlier a little bit under pressure. DigiCo REIT has made its trading debut in Sydney just at noon, going noon in Sydney time. It is a data centre provider. It is the biggest IPO that we've seen in Australia this year. They raised 2 billion Aussie dollars. That's 2 billion Aussie dollars. That's 1.3 billion US, making up pretty much the entire IPO haul that we've seen for 2024.
Yeah, let's bring in Matt Ingram, our senior analyst, to talk us through this. So Matt, biggest one in a few years here. what does a company do with that money?
Yeah, g'day, David. Look, it's to buy an asset in Sydney, and it's a very pricey asset. In terms of the yield on that asset, it's about 4% versus 6% globally. It's a very, very good asset. It's very close to the city, but they're basically getting a good foothold in a very good place in Sydney with the IPO proceeds. It's also obviously going to allow them to grow into those other assets that are underutilised at present.
Matt, just shifting to HSBC, because you've looked at that stock for a long time. We've heard from other media sources that they're looking at their retail banking operations outside the UK and Hong Kong. Do you have any perspective that you can share on that?
Yeah, g'day, Annabelle. Look, this is a long saga, particularly in HSBC Mexico. They bought that business more than 20 years ago. They had big issues with the US regulators regarding that business and supposed dealings with the cartels. And frankly, those businesses, apart from the UK and Hong Kong, are subpar on a profitability basis. So as we've talked about with the investment bank, it's a case of how do you cut without cutting too deep. And they have got a fantastic private banking network globally, but a lot of those retail franchises globally just aren't up to the mark from a profitability point of view.
Yeah, Matt, how do you think the story looks next year, particularly, and you and I have had conversations offline about this, new leadership? I'd even mention, and obviously not apples to apples, what Citi did with their wealth business and their retail business in the Asia Pacific, and they pulled out from several key markets. What are the things to watch going into the next 12 months here for HSBC on the specific retail presence?
There's a lot of moving parts, David. Yeah, one of the things we've also talked about offline is this impact of the Fed, and clearly HSBC's front and centre when people are talking about a more dovish Fed and whether the Trump election's going to change that. HSBC is going to have some headwinds on the revenue side, as we've talked about, and that really hits the road most notably in the retail bank. So at a time when you're swimming flat out to stand still on costs, they're going to be restructuring retail, they're going to have revenue headwinds. It's really hard to see how the new management team get a good outlook for 2025, frankly. There's a lot of noise there, and there are a lot of revenue headwinds. It is an excellent franchise, particularly the UK and Hong Kong, and those businesses, even in bad cycles, do well. So I think they remain the crown jewels. The cutting around the edges is going to create noise and a lot of management headaches.
Matt, I'll borrow your swimming phrase there. You'll get this pun, watch the jaws, or watch jaws, as they say, on HSBC. Matt, thank you so much. Matt Ingram there, Bloomberg Intelligence, senior analyst. Another tech stories we're following this morning, Google and Samsung have partnered to create this new operating system and headset for the mixed reality market, challenging devices from Apple and also Meta. Now, the new version of Android's operating system is designed for extended reality. The Samsung-built headset is codenamed Muhan, which we're told is infinity
in Korean.
In Korean, there we go. That's set to debut sometime next year. Now, Bloomberg has learned that China's Instagram-style app, Xiaohongshu, has told investors it's on track to double profits this year to over $1 billion. Now, the strong results are likely to revive speculation about an IPO from the company. Now, Xiaohongshu has grown rapidly to 300 million active monthly users. That's partly at the expense of the likes of Alibaba and also JD.com.
All right, coming up, we're going to be diving into today's big take. It is looking at how human eggs are actually becoming a premium commodity for the global fertility trade or the global fertility market. So we'll be looking at that, the perils of it. More ahead. This is Bloomberg. Well, the human egg trade has morphed into a global business worth billions of dollars, but it could be coming at a human cost that really just cannot be measured. For today's Big Take, Bloomberg reporters tracked the egg trade around the world, including in India, Argentina, Greece and Taiwan. Our breaking news editor, Cindy Wang, is joining us. So, Cindy, talk to us about the reporting that was done on this piece and who you interviewed, exactly what was found.
Hi, Annabelle. Yes. So the story is about how the booming fertility industry around the world has turned the women's egg into precious commodity. So it's fundamentally about commodification of women's body. We investigated in 11 countries about how egg donors are recruited into the global, 35 billion and growing global market of assisted reproduction. This industry comprises would be parents, donors, their agents, doctors, and fertility clinics. And many of the fertility clinics, they're invested or backed by Wall Street's investment banks and private equities because they see this as lucrative business. So the demand for human eggs are only expected to grow because more and more women are trying to have babies when they are older. And as women age, the number and quality of the human's eggs would decline. So the demand for human's eggs will only be stronger, and that makes the women's eggs more precious. So in the piece, we interviewed and followed several donors around the world, that including a donor in India. When her eggs were harvested at a fertility clinic in India, her government ID showed she was only 13. And we also talked to a model in Argentina and 2 egg girls from Taiwan. So donors from these countries, they have repeatedly evaded U.S. immigration control to try to sell their eggs in the U.S. via the help of Americans' fertility clinics. These clinics, they are often aware of such illicit border crossing, but they still let these things happen. And also, we've talked to the police in Greece, and so the Greek police found out that there are as many as 75 cases of alleged theft of human eggs taken from ovaries of IVF patients at local fertility clinic. And also in China, even though the country bans buying donors' eggs, but obviously there is a big black market where donors would be taken in a van with darkened windows to an unknown lab outside of the big cities. It looked like it would just be an average residence, but inside this residence there are equipments and well-trained doctors that would help the donors to retrieve their eggs. So these details that tells us that the egg trade, the human egg trade, is really booming. It's absolutely booming and thrives in the open markets, gray markets, and black markets globally.
Yeah, no, pardon the expression. I'm trying to wrap my head around all these things in the story. I mean, you talked about some of the people you talked to, and one example, and I think this is good to highlight for our viewers here, one donor who's based in Taiwan actually traveled to the U.S. 11 times to do it, earning $25,000 each time. What is the incentive? Well, the incentive is clear, but how much of this actually happens?
Well, yes. So the egg donation is legal in Taiwan. So, but in Taiwan, every donors, they're only allowed to donate their eggs once if there is a baby is born as a result. And also, donors in Taiwan can only get paid of around $3,000 US. So the donors that we talked to said, if I'm going to undergo the same pain and trouble for egg retrievals, why don't I do it at a place where I can get more money? So these donors that you just talked about, she chooses to do it several times in the U.S., obviously because in the U.S. it's a free market that the compensation can go up as much as the would-be parents are willing to pay. So there actually is no limit. So the compensation is really what drives these donors from these countries for them to travel all the way to U.S. to donate their eggs. Just to be clear, egg donation is nothing easy. The donors, they have to inject hormones for 10 to 14 days, and that would make their bodies very tired, cranky, uncomfortable. And then they have to go under anesthesia to retrieve their eggs. It's literally like a small surgery. So it's nothing comfortable. It's nothing like a sperm donation. And also, they have to come past this U.S. customs. They usually have to pretend that they're tourists because they're holding the travel documents as tourists. So they have to book a hotel, book the tickets, and then have the vacation itinerary to try to get to the U.S. customs. Because otherwise, if they are found out, they just have to be sent back and probably will be banned from entering U.S. for 5 years. So with high compensation, that also comes with high risk.
Yes, Cindy, and we're just showing there a strap saying that the long-term risks of repeated egg donation are unknown. But that was Bloomberg's Cindy Wang there. And as Cindy mentioned, India has quite a significant role in this $35 billion industry, driving that trend. Impoverished women in some cases, desperate to survive, and doctors who argue that the new rules are putting donors at risk. Our team at Bloomberg Originals takes a look at the true price of a human egg.
All my husband does is get drunk and sleep. My kids and I won't be able to eat. We've also considered killing ourselves. Sumathi took me to a clinic in Vadalur. I was too weak to donate enough blood, so I said eggs.
The Dalits are among the most marginalized groups within the Indian caste system, often deprived of quality education and jobs.
All of us women are sanitary workers. I'll get 450 rupees a day. 100 rupees go toward our food.
But these women carry something more valuable than anything among their family's modest possessions: their fertility. It's an open secret that she is the fertility agent. She's a cog in a sprawling network of agents and go-betweens across the country, profiting from the sale of human eggs. Every 15 seconds or so, human eggs are taken from a woman somewhere on the planet to satisfy the global demand for assisted reproduction. Advocates warn that India's poorest women are at the mercy of an industry that preys on the most vulnerable. For Sumati and the other women in her village, the people who make the laws feel worlds away.
Sometimes we do regret donating ovarian eggs out of haste for the sake of debt relief.
Then go back. Well, you can read more about the global trade in human eggs. That's today's big take, available for subscribers on the terminal or on Bloomberg.com. You can also catch the full weekly documentary on YouTube. We have more ahead. This is Bloomberg.
All right, a brief look at markets in South Korea going into another potentially potent, apologies for using those two words together, weekend. But yeah, I mean, this events there seem to suggest Saturday and Sunday are pregnant with possibility going into that as well. So we're watching markets, and as you can see, we are seeing a buy and dip scenario here after, 3 days of losses, I believe. I'm losing count now. It's been all over the place. But at 2,400 still, this is really one of the worst performing markets. And certainly there's another layer of premium that's been built into these markets because of what's taking place. Now, still in South Korea, but completely nothing to do with the political gyrations taking place there. One specific stock has been doing absolutely well. This is Samyang Foods. This is in case you don't know this and live under a rock, this is the one that actually makes the super spicy buldak, I'm not sure if I pronounce it properly, instant noodles. It's up more than 200% this year, and it's turned some of the people involved into noodle billionaires here because of what's taking place. And I don't know, what do you know about the stock or the company?
Well, this company in particular and their noodles, which are buldak is fire chicken or fire chicken? Yes, fire chicken noodles. These are so spicy that they were actually taken off the shelves in Denmark earlier this year. That's how spicy they are, because there were concerns about the health risks. They came back onto the shelves, but it's sort of become like a social media sensation because people want to see other people essentially struggling to eat through these noodles. But it's an incredible story because the person behind this all is Kim Jong-soo, who's a 60-year-old now an heiress, but essentially she was asked to join the family business. It's her in-laws. That family business was struggling back in the late 90s. She came on board. She had the idea for these spicy noodles because she'd seen people eating them in restaurants, and then she just completely turned it around. So it's an incredible success story.
Yeah, well, for them, I'm not sure if you're up for this. I can't wait to never try this, to be completely honest. But yeah, too spicy to become illegal.
In Denmark, I mean, that was
and
sort
they're
of
liberal too in Denmark too, if you think about it.
That's true. Obviously not about their stomachs. But anyway, insights coming up. This is Bloomberg.